Well, last week we had the 10-year yield range from 76 basis points all the way up to 87 basis points. Now, 11 basis points may not be a massive move in so-called normal times, but it is these days. So let's bring in Jim Bianco of Bianco Research to tell us what kind of volatility we're seeing and what does it get you, Jim?
Hey, thanks for having me. The bond market's volatility normally is not a big deal, but given 11 basis points in a week is not the craziest thing you would have seen. But given the environment we're in, it is a massively large move. And it came on the back of a stock market that sold off over 5%. That was probably the most surprising part about it, was there was no risk-off rally in the bond market last week. And that's what's got everybody shaking their head right now.
So, Jim, we have the election coming up tomorrow. How are you kind of, I'm not going to say playing it, but how are you forecasting how this market's going to react going forward? What's kind of your base case, what we're going to see tomorrow and the days ahead, and how that might impact the credit markets?
I have a little different base case than most. If you look at the world of the polls, they're giving Trump, I'll go with the incumbent point of view, about a 5 to 10% chance of winning. If you look at the betting markets, they're giving him a 41% chance of winning. The betting markets seem to align with the financial markets. I think the financial markets think that Biden is leading, but it's very, very close, where the polls are saying it's going to be a very lopsided race. If the polls turn out to be right, and it is as lopsided as they say it is, I think there's going to be a lot of discounting in the market tomorrow or Wednesday into Thursday as they start to price in more of a Biden victory than they have right now. And I think ultimately how the markets price that in, it's going to come down to how the Senate goes. The Senate, I think, is going to probably be the real story as we go forward from here, because that's kind of touch and go as to which way it can go. Wall Street wants a blue wave because it wants fiscal stimulus. And I think if it gets that blue wave, there's probably going to be a rally based on the knee-jerk reaction. But I don't think that blue wave is as completely priced in as a lot of people think right now.
Well, there's also a very real possibility of the presidency turning over, but not the Senate. In that situation, Jim, what are we looking at in terms of policy for the next 4 years?
Well, for the next 4 years, history says that should be bullish because Wall Street has always liked gridlock of any kind. That seems to be the best scenario for it over the next several years. Over the short term, it won't like gridlock because what it wants right now is it wants a fiscal deal. And if we were to get the Senate to be held by the Republicans, then what we would wind up having happen is the less likelihood of a fiscal deal at that point.
So, Jim, I mean, if you look at the 10-year, it's been trading after that volatility in March. The 10-year's kind of been in this range of 60 to 80 basis points. Is there a scenario in your analysis where we get the 10-year to, 1%, 1.25%, something like that in a reasonable time frame?
Sure, and I think there's a likely scenario with that, and that is the return of inflation. With all of the pump priming that we've done with the fiscal stimulus and the monetary stimulus and the contraction of the economy, meaning we're making less stuff, less gross domestic product, that is a prescription for higher prices, otherwise known as inflation. If the market thinks that inflation is coming back and coming back in a big way, yeah, you'll see investors run away from the bond market and you could see higher yields. In fact, I think that might be one of the things that's been bothering the market the last couple of weeks, even though the stock market has stumbled and the bond market's been unable to rally on that, is I think that there is this fear of inflation. If you add to that one other, and that is a vaccine. If you keep sending people money and you keep priming the pump, and then you get a vaccine and tell everybody, okay, now we can go back to normal, that really underscores the idea that you could get a return of inflation. So I do see that as a plausible scenario for much higher yields as we move into 2021.
So interestingly, Jim, the person we maybe should be watching then is Jerome Powell, because he has basically, and his Federal Reserve has basically promised ultra-loose monetary policy for years to come. But in the scenario you just described, the bond market would be telling the Fed to actually raise rates, no?
Yes, that's exactly right. We all have been looking at Powell and thinking that he's been the guy that saved the markets, and that's largely been the case for 2020, and he's promised not to raise rates for years with an S on the end of it to come. The only thing that changes that is the market itself. If it decides that it wants a change of policy. It did so in the fourth quarter of 2018 when the Fed was reducing the balance sheet, and it said stop, sold off the stock market really hard until Powell changed his mind and said he'd be patient and flexible. If we get inflation, we could see something like that in 2021 where the market doesn't about face and it demands a change of policy, and eventually the Fed will coerce and give it to it.
Hey, Jim, thanks so much for joining us. We appreciate it. As always appreciate your thoughts and opinions. Jim Bianco, president and founder of Bianco Research. He's also a contributor to Bloomberg Opinion, joining us, and he's based in Chicago.